On the Money with Peter Switzer. Want to hear a segment again? Go to talkinglifestyle.com.au and download the podcast now.
Well, we're growing fond of that $6,000, 6,000 point mark on the markets. It's dipped below today. Let's find out why. Michael Wayne joins us again from Medallion Financial. Nice to have you on the program, Michael.
Thanks for having me, guys.
Hi, mate.
Hello, Peter.
Well, last night,
We'll speak to you again.
I was talking to you last night at my TV show, and you didn't alert me to the fact that we'd be down under 6,000. So what was the driver, Michael?
Yeah, well, after a resilient day yesterday, the market was off sort of 0.9%, and that was driven lower by the big four banks, all down over 1%. The energy stocks were down heavily after Shell exited their stake in Woodside. It's difficult to put your finger on exactly what caused the big sell-off today. We had shown some resilience leading up to that, and I mean, the market was up 6% in October.
Yep.
So I think it just makes sense. It's a little bit of a healthy correction, a bit of consolidation. I think it's important that investors don't let hubris get the better of them.
Yeah.
And after the big rally that we've had, lock a little bit of profits in and reassess a little bit. But it was pretty broad-based selling today across the board.
Was there any kind of concern that Donald Trump might not get his tax changes through, as soon as possible?
Look, there has been that creeping back into some of the news that's been coming out of the US. There's been some talk that it might be pushed out from a 2018 tax cut towards 2019. But the US markets were fairly strong overnight. They were actually higher. The futures are down very slightly for the US markets at the moment, but there hasn't been too much movement in those markets. There was some data coming out of China today. The retail sales figures missed expectations by a sizable amount. Fixed asset investment was slightly weaker as well, and that could have put a bit more downward pressure on the ASX as the day went on. But in saying that, the Australian data that came out today was very strong. Business conditions were the highest reading ever for the NAB business survey.
Great
so that's something
stuff.
to look forward to.
That's great to hear. and business confidence as well.
Yeah, look, not quite at all-time highs, but certainly above the long-term average. Employment conditions remain very strong as well, so there are certainly things to be optimistic about on the domestic front. I just think it was a sell-off based on the fact we've had such a big rally and a bit of profit-taking coming in, but nothing to be too concerned about yet, in my opinion.
Okay. Any stocks that you looked at today and said, that's a nice fall, that could be a buying opportunity?
Oh, look, I was sitting on my hands, I must admit, today. Something like Woodside was down sort of 3.5%. The situation there is Shell, the large international energy company, sold down their 13% stake.
And they've been talking about this for nearly a decade, haven't they?
Yeah, look, I think they've first invested in Woodside at around the $4, $5 mark, going back a long time. And I think it's just got to the point now where it's non-core asset on the Shell balance sheet, and they've decided to sell it off. The thing with Woodside is it is ex-growth or lacking growth prospects out there. It's a very high-quality business with a very strong balance sheet, but management have to find the next driver of growth for that business. So perhaps Shell have made a decision. It's time to exit that business, and they can look to redeploy those funds elsewhere.
And what's this current share price, Woodside?
At the moment, it's $31.20.
So they bought in at 4 and they're selling out at 31.
Yeah,
that's not
a bad return.
Not bad return.
Take that any day of the week.
Yeah, without a doubt. All right, mate. So any other news that you think is relevant for people out there who are thinking about playing the stock market?
Oh, look, I think this time of year we've had a very big run-up. November, we tend to consolidate a bit, but the Christmas rally, and that's always out there on the horizon. I don't expect us to sort of rally too strongly from here on towards the rest of the year, but I certainly expect us to reclaim that 6,000 level before the end of the year. So no need to panic just because we've had one 50-point negative day.
Yep. So it could be a buying opportunity.
Yeah, I think buy the dips, that's certainly been the trade for the last couple of years, not only here in Australia but overseas as well. But it'll be interesting to see whether the buyers do come and sort of pick the market up from this point. But that's certainly been the trade for the last sort of 12 to 18 months.
Michael and Switz, we follow the market every day and check it out. We're always happier when it goes up, a blip up of 1% is pretty good. A blip down of 1% is pretty normal. It always seems to be a fairly common amount. Is about that 1% mark. Would that be a fair call?
I think there's a range there, and I'm interested to see Michael, because he even watches even closer than I do. But I would have thought that it's kind of 0.5 to 1 edge, and go over 1%. That's kind of a significant drop. What do you think, Michael?
Yeah, look, I think you're spot on. Sort of 0 to 0.5% is probably the standard move. In the US, I don't think they've had a 1% move either way, or certainly not a 1% drop for almost sort of 6 months to a year, I think it might be.
I think I'll give it to you precisely, because I wrote about this on Monday. they have not had a 2% drop in the market for 60 weeks. And I think it has been 6 other occasions when they've gone 50 weeks without a 2% drop. Mm-hmm. And what history says is when it does drop more than 2%, it then rebounds. So it's like a positive scenario, despite the fact that we might see a 2 or 3% drop. The history sort of says, well, why did the market like the market for so long? And that kind of explains a big rebound could be there.
So that's in the US. Do we mirror that a bit too?
Well, generally, we do follow Wall Street unless some strange circumstance comes along which decouples us. But I'd say more weeks out of what's the right English I'm looking for, Ed? Help me here. More weeks than not, we do.
While we've got you there, Michael, we've got an email up on our screen. Maybe you can chime in as well. It's from Samuel in Corinda in Brisbane. I'd like to invest in China. What are your thoughts on buying some Hong Kong-listed Chinese equities? Sort of out of...
8 shares.
Yeah,
8 shares, yeah.
It's a way of playing the Chinese markets without having the direct exposure. So these are companies that are based primarily out of Hong Kong. It tends to be the more established businesses, a bit more liquidity as well. So that is certainly a way. I know in the past that there has been an ETF on the ASX. I think it's still there. I think it's IVV or IZZ, so you have to double-check that one. And that will give you exposure to the H shares, so the China-exposed H shares listed in Hong Kong.
Yeah, and basically, if that market does well with the ETF, up goes your value.
Yeah.
Yeah, so it's IZZ. I just quickly confirmed that. It's trading at $61.32, and it's had a fairly good run of late. So that's probably the best way to play it. That way you don't have to pick specific exposures. You can just get the broad-based exposure to that region through IZZ.
Alrighty, thank you for that. Samuel, hope that takes care of your question. You can reach us via email, as Samuel did, at talkinglifestyle.com.au, or hit the phones, 13 12 83 for any of your financial, indeed any money-related questions as well.
Anything that has a remote link to money will find a way of actually making you more money.
We'll let you get back to the business of making money at Medallion Financial. Thanks, Michael, again, mate. We'll chat down the track.
Thanks, Ed. Thanks, Peter.
Good
pleasure.
Man. All right, well...